All right, class. Today we'll start chapter 8. So you can think about this is the class for July 10. So today we are going to talk about stock. So basically, when you say stock, we basically refer to common stock. And if you can remember in the last class, we are talking about bonds, right? So we are saying that when a company took the capital budgeting decision, like they are going to invest in certain assets, they also have to think about at the same time from where they should raise the funds so that they can invest in those assets. And the answer is they have to get the money from stockholders or they have to get the money for creditors. Creditors could be bank loan providers, bond investors, notes investors. In the last class, we actually talked about creditors, like the bond investors with bond. Today, we're talking about stock investors, stockholders. So basically, when you say stockholders or common stockholders, we're talking about these are the people, they actually own the company. So end of the period, they actually enjoy dividends and they actually are the owner of net income. And even if there is a loss, net loss, they will take care of that net loss. So they are the actual owner of the company. So when you say stock, we basically refer to common stock, but stock could be two types: common stock, preferred stock. So common stockholders is basically the actual owner of the company. And if you want to talk about some features of common stock, they have voting rights. So basically here voting rights means for any operation related terms and conditions, for any decision making, board of director choosing, common stockholders can cast the vote and they can participate in the decision making process, like how the company should be run. And sometimes if common stockholders, they cannot vote for themselves directly, sometimes they can delegate this right to someone else, that someone else will cast the vote for them. This is called proxy voting. Classes of stocks. Sometimes common stock are issued in two different classes, like class A, class B. The only difference between classes of stocks are they come with different number of voting rights. Maybe class A have only one voting rights, class B have 10 voting rights per stock. So if you own one class A stock, you have one voting right. If you own one class B stock, you have 10 voting rights. So classes are only different in terms of voting right per stock, okay? But other than this, all else, let's say dividend, let's say EPS, let's say losses, all else are same. In liquidation, they will get the same preference, all else are same. And also you have to remember, stockholders are the actual owner of the company. So in bankruptcy, in liquidation, they will get the money at the very end, at the very last, okay? Some other rights, they enjoy dividends, but dividends are not a fixed burden like interest payment, okay? And then in liquidation, they get the money, but in the very last, sometimes, not always, common stock comes with preemptive right. Like, what does it mean? So let's say this way. Today, Intel issued 10 stocks to 10 investors. 10 investors, and all of those 10 people own 10% of the market, right? Because each investor owns one stock, which is 10% of the ownership, right? Now, this is all about today. Five years later, Intel may decide, 5 years later, Intel may decide, I want to issue 10 more stock. We need more money for fixed asset investments. In that case, if the initial stocks, which are these are, if the initial stocks were issued with preemptive rights only, then Intel has to offer these 10 new stocks to the existing 10 investors first. And this existing 10 investors have the right to decline the offer or not first. If they decline, then it will go to external investors. Makes sense? So the idea is when any stocks comes with preemptive rights, it means for subsequent stock issuance, the company has to offer the existing investor first so that the existing investors can maintain their proportional ownership. If the existing investors decline it, then it can go to the outsiders. So that is called preemptive rights. Some characteristics of dividends. Dividends are not liability of the firm, okay? Company can decide to pay, not to pay, doesn't matter. If the company do not pay, the stockholders do not have the right to file for bankruptcy. This is not a fixed burden. Dividend payments are not fixed burdens, not considered as business expense, okay? That's why they are not tax deductible. And you can remember from the income statements, after company pay the tax, they got the net income, and from that net income, they decide to pay dividend or not. So dividend decision comes after tax payment. On the other hand, interest expense adjusted before tax payment. That's why interest expense are tax deductible, dividend no. So any questions so far? Now let's talk about a little bit about preferred stock. This is also a kind of stock, but this is more known as a hybrid instrument because it shares some characteristics from bonds and also shares some characteristics of common stock. Now let me tell you some commonality. So it shares some characteristics of common stock because preferred stockholders got dividend, okay? Same time, it's not a liability. If the company do not pay preferred stockholders dividend, they cannot file for bankruptcy. But most of the cases, preferred stock dividends are cumulative. That means if the company decide in year 1, they will not pay dividend, that will be cumulative. In year 2, if the company wants to pay dividend, they have to add the year 1 dividend with year 2, and then they're going to pay the dividend. So the idea is preferred stock dividends are cumulative. So going forward, if they missed any dividend, they will be added with the next payment. So all missed dividend payments will be added. But for the common stock, this is not true. If it's missed, it missed. And that's why preferred stock generally does not carry voting rights. So given the cumulative term, you can think about preferred stock dividend is a kind of fixed expense. And you can think about preferred stockholders do not have the voting rights, which is very similar to bond. On the other hand, dividend is not a liability to the preferred stockholders. It's not tax deductible, which is very similar to common stock. So that's why they share some characteristics from bond and common stock, and that's why it is known as hybrid instrument or hybrid security. In liquidation in bankruptcy, bond is paid first, then preferred stockholder, then common stockholder. This is the chronology. Bond, preferred stock, common stock. This is the serial. Now, what do we learn? We learn what is a stock, 2 different types of stocks, some characteristics of dividend. Now, you guys may be excited about how can we do the valuation of common stock or preferred stock. So for valuation, we know that whenever we talk about value of any security, we know that present value of expected cash flow, right? Now, I have to understand the 2-step process. How can we do the present value? We have to discount it, right? We need a rate of return, interest rate to discount it, right? So for the bond, the discount rate, which is also known as required return or discount rate or expected return for the bond. Okay, I repeat, for the bond, you can get it from the market. So for similar risk characteristics, what is the required return or expected rate of this bond? Go to the market, get the information. But for the stock, expected return, required return, process is actually the same. So your first job is to identify how risky this stock is. If you know the risk characteristics, risk type of the stocks, then there is a formula which is known as CAPM model or CAPM formula, CAPM model, which we're gonna do maybe in chapter 13, okay? And we're gonna learn that how we should calculate the required return of a stock. So for this chapter, we will say required return or discount rate is given, okay? But in chapter 13, we learn how to calculate that. This is for stock, but for bond, go to the market, look at the rate offered in the market, and then use it. Cash flow. Two different types of cash flow. One is dividends, and the other is future stock price. So dividends, we have to identify how much company wants to pay the dividends. Future stock price, you can say, you can get the data from market information, or you can say future stock price is also a function of expected dividend. So the problem will tell you, okay, so the problem we're gonna do in this class, we're gonna see there's a sufficient information about expected dividends, and about the future price. Either the problem will tell you the future price will be $50, $30, something like that, or from the expected dividend information, you can also tell the future price. Makes sense? Now, we have to refine this definition a little bit, because we're talking about value of any security is basically present value of expected cash flow. This method is known as absolute valuation methods. Absolute valuation method. This method is known as absolute valuation methods. On the other hand, there is another valuation method that is known as relative valuation method. So when you say absolute valuation method, we actually referring to the company's cash flow generating power and then discounting those cash flows today and find the present value of those cash flows. This is the value of the company. That's it. For the relative valuation methods, what we're trying to do, we are trying to find the value of a company compared to similar firms, compared to competitors. Some proxies for relative valuation methods are PE ratio, price to sales ratio, EV to EBITDA ratio. If you can remember, we did it in our ratio analysis class, right? So the idea is, if we know the expected earnings, expected sales, or expected EBITDA of a certain company, and if we know that in the market, a similar firm is trading at 10, 20 multiples of P ratio, we can find the value. So I'm just giving you the definition. We'll definitely work on it, okay, in this chapter. But the idea is, if we know the certain variable, which could be earnings, sales, EBITDA, and if we know how much the similar firm is trading in the market, we can calculate the ratio, calculate the value, and we can find what should be the value of that firm under relative valuation methods. Make sense? Okay. Now move on to chapter slides and talk about this valuation techniques in terms of examples and problems. Now, okay, let's move on. So let's talk about the absolute valuation method, right? So we know that company pay dividends and there is a future sale price. If you can discount with the required rate of return, we can find the value of the stock, right? Now let's talk about this one period model. So here is the thing. Bond has a fixed maturity, like 5 years, 3 years, 10 years. Stock do not, because if you can remember, corporations can run their business forever, infinity. In that case, corporations' ownership is represented by the stock ownership. So that also has a life for future, infinity. So you cannot say that. You cannot say that it has a 5-year life. So you have to think about how much as an owner I want to hold these instruments. I want to hold these instruments forever. That's not the formula we have used. I want to hold this instrument for 1 year, 2 year, 5 year. So right now, this example is trying to tell you if you want to invest in one stock for 1 year, given this information, what should be the value today? So $2 dividend in 1 year, and then $40 is the selling price, 20% return for similar risk class. How much value should be, right? So here, 2 cash flows, dividend, 14, right? So you can say, let me check. Yes, you can say 16, right? Find the present value, okay? You can do it in the function calculator. Okay, clean it. N is 1, discounted 20. And you can say both way. You can say, because it's a 1 year model, doesn't matter. You can say payment 2, future value 14, compute present value 1333. Negative because price is investment today negative. So did you see that? 2-period model, same thing. Identify the cash flows, discount back today. So just go over it, okay? 3-period model, same thing. Identify the cash flows, discount back it today. So basically, it's trying to say 2, 2.1, 2.205, and 15,435. So if we elaborate this one, let's say 2, let's say 3. Two, 2.1, and then 2.205. And then price is 15.435, 15.435. So in that case, you can find the present value of each of this cash flow individually, and this one too. So basically, your final cash flow, you can say sum of these two, right? This is your final cash flow, right? Now, if you discount divided by 1.2 to the power, be careful, to the power. This is year 1 cash flow, to the power 1. You think here, year 2 cash flow to the power 2, year 3 cash flow to the power 3. And if we just sum them up, are 8.33. There's the thing. So don't think that it's just a like simulated numbers. It doesn't mean if you want to hold it for 1 period, 2 period, 3 period, doesn't mean it always has to be 30, same price. It's a simulated number, okay? Now, this is, I'm just trying to give you on a rough basis how the dividend pricing model should work, okay? Or the present value of stock should work. But in general, sometime or most of the time, dividend follow a certain trend. So what does it mean? So dividend follow like constant dividend forever. So if a company pays $2 today, they will keep paying $2 forever. That could be on the model. Or sometimes company prefer 1% growth in dividend each year, 2% growth in dividend each year, okay? So in those cases, those dividend follow for infinite years, and you have to use some models, otherwise you cannot find the value. And the third case could be that dividend follow higher rate, a higher growth rate for next 2 to 3 years, short-term period, and then dividend follow constant growth rate forever. So in those cases, you can predict the dividend for short-term period, but for the constant growth rate forever, you cannot predict the dividends, right? Because you don't know when it's going to end. So when there is a situation that dividend can either grow at a certain rate or dividend will not grow at a certain rate, but will be constant forever, the term is forever, you have to use certain models. Otherwise, you cannot find the value or you cannot calculate the value. So now we are talking about 3 different models. Constant dividend forever, okay? So that means company paid $2 today, it should exist, okay? Forever. We don't know. Forever, right? We don't know. Now, present value today. Present value today is a function of expected dividends. And the expected dividends start from here, not zero. Okay. In stock valuation, anything that already paid will not be considered. We don't consider whatever is paid, it's gone. It's already reflected in the price, current price. What do we think about? Future. Okay. Expected. So starting from here, present value for the expected cash flow. Okay. So this is an example for preferred stock because preferred stockholders do not enjoy the growth in the dividend. Their dividend is fixed like interest payment in bond. Okay. Now, constant growth model. So constant growth model is basically a model where dividend will grow at a certain rate forever. So that means today they pay $2, and if they decided they will increase the dividend for 3% forever, that should be the dividend look like 3% forever. Okay. Now, present value is the price today is basically the present value of expected dividend starting from here. Okay. Make sense? So for the constant dividend model, the formula is perpetuity formula. If you can remember from the chapter 5, I believe, the perpetuity formula is basically present value is basically cash flow for here is dividend divided by discount rate. Cash flow for here divided by discount rate. Present value growing perpetuity formula, which is future cash flow C1, which is D1 here, divided by discount rate minus G. Now, some slides, some books, sometimes they use it R. Okay, sometimes they use it R, sometimes they use it K. Same thing. Required return on the stock, expected return on the stock, discount rate of the stock. Same thing. Okay. Now, this is the supernormal growth or constant growth, non-constant growth model. So this model tells that dividend will grow at a higher rate in initial years. Let's say dividend will grow 10% initial years. Let's say for past 3 years. It could be different, 2, 4, 5, depending on the company. After that, dividend will grow constant rate forever, which is, let's say, a lower rate, 3%. Right? Right? So in same case, present value of expected dividends. Okay. So in this chapter or in this course, we are not going to go over of this formula because if you will be taking investment class going forward, you will do it a lot. So this is the intro to finance class. We don't want to do complex things. So we are not going to do this in this class. Okay. But we're going to do constant dividend and constant dividend growth. Constant dividend growth models. Now, constant dividend model is also known as zero growth models, right? So let's think about this one. Stock is expected to pay 50 cents as a dividend, okay? Required return 10%. So 50 cents dividend per quarter, required return 10% annually. So what we're doing, cash flow, and then periodic discount rate. This is the price of the stock today, preferred stock today. Now think about this problem. There is a company, they just paid dividend 50 cents. So just paid means D0, year 0, dividend 0. 50 cents. Dividend is expected to grow 2% per year, okay? So growth rate is 2% per year. Required return could be R, could be K, doesn't matter. 15%. How much the stock should be selling for today. That means how much the stock should have the value, fair value today. So price today is a function of, we know that, the formula. Cash flow tomorrow, C1, be careful. Cash flow tomorrow divided by R or K minus G. Now here is the thing. We don't have the information for D1, right? We have the information for D0. So D1 is basically D0 times 1 plus G. So D0 is 0.5 times growth rate to 1.02. Make sense? And that should be 0.5 times 1.02. So be careful. Problem could say already paid D0. Problem could say next year dividend D1. So we need here D1. If the information we have is last year, we have to compound it. We have to grow it. If the information we have next year, do not compound it anymore. It will be a double counting problem. Okay, do not compound. So here we have the last year information. That's why we compound it. So 0.51 divided by R is 0.5 minus 0.02. So that should be 3.92. That's the value. Make sense? Okay, another problem. Expected to pay $2 next year. So expected to pay $2 next year. Growth rate 5%. Record return 20%. What is the price today? So we know the formula. So formula is this one, right? So this is our formula, right? Now here, expected dividend is already given. So don't make it compound anymore. So it should be $2 divided by 0.15, right? Because 20% is record return, 5% is growth. So equals to 13.50. That's it. So we did constant dividend zero growth model. We also did constant dividend growth model. Now, these are something you can think about stock price sensitivity to dividend growth. So the idea is dividend is your cash flow. If you get more cash flow, which is coming from higher growth, your price should be more. On the other hand, stock price sensitivity to required return. If the discount rate is more, we know that from the present value relationship, discount rate is more, stock price will be less, negative, okay? We're not doing this. This is for investment class. No, I think the investment class is here. So we're going to do this. Let's see. Yes, we're going to do this. So he's saying that there is a company that is expected to pay a dividend of 4 next period, and dividends are expected to grow at 6% per year. The required return is 16%. What is the current price? So expected next year, which is D1 divided by 0.16 minus 0.0640. Now, here is the thing you have to be careful. Price today is based on dividend tomorrow. Okay. Now, if I want to play with the formula, let's say we want to say what is the price at 3. So that should be based on dividend 4 divided by R minus G. Make sense? So it doesn't matter, small g, big G doesn't matter, same thing. So you have to understand this relationship, okay? That's going to be helpful. In that case, what is the price expected to be in year 4? So price in year 4 is a function of, if you look carefully, D4 times 1 plus G, which is D5, okay? So R minus G. So what they did, they actually give the dividend to D5 until year 5, and then discount the same R minus G, and that is the price in year 4. Makes sense? So understand the relationship. So this is basically non-constant growth. We are not going to do that. This is for investment class. Now pause the video here and try to solve it by yourself, and then match with me. What is the value of stock that is expected to pay a constant dividend of $2 per year if the required return is 15%? So P0 is basically 2 divided by 1.5. Sorry. 13.33. What if the company starts increasing dividend by 3% per year, beginning with the next dividend? The required return stays at 15%. So basically, they will not pay $2. They will not pay $2. So it's saying that companies expect to pay constant dividend $2. No, they say dividend will grow 3% next year with this $2. In that case, P0 is basically 3 times 1.03 divided by 0.15 minus 0.03, which is 17.15. Okay. Now, so far we learned how to find the price today, right? Now, what if we want to know what is the required return or expected return of any stock investments? We know that we're going to learn it, the actual big formula in chapter 13, which is CAPM, but we can also estimate approximately from this formula. So if you look this price 0, this is the constant dividend growth model as a function of D1 divided by R minus G, right? And if we rewrite, this is R is a function of D1 divided by P0 plus G. So you can think about this is the dividend yield, this is the capital gains yield. So capital gains yield means the growth rate of dividend, which will also be reflected on the price changes, okay? Price changes. So this is your expected dividend divided by today's price and price changes, which is basically the growth rate. So here is a formula. Sorry, you have gone through the formula. Here is an example. Farm stock selling $10.50 today. Just paid $1 dividend. So just paid D0. Expected to grow 5% per year. Required return. So just paid. So D1 means 1 times 1.05. D1 divided by current price plus the growth rate. So that should be the required return. Now you can think about what is the dividend yield. This is your dividend yield, which is 10%. Capital gain yield. This is your capital gain yield, 5%. So dividend yield is basically 1.05 divided by 10.5, which is 10%. Capital gain is basically your growth rate is 0.05 or 5%. Make sense? Same thing. So do it by yourself. So stock price 1875 is today's price, which is P0. Expected dividend growth at 5%. Most recent dividend was 1.50. Required return is a function of D1 divided by P0. This is known as dividend yield plus growth rate or capital gains yield. So dividend yield is basically 1.5 times 1.05 divided by 18.75 plus growth rate is 5%. That should be 13.4%. So far we did absolute valuation techniques. Now we're talking about relative valuation techniques, and we have an idea of what is a relative valuation techniques. So the price of relative valuation techniques according to P formula. So for the relative valuation models, you have to find out the proxy. Do you want PE? Do you want price to sales, EV to EBITDA? You decide. So the price here is benchmark P ratio, which is similar firm or competitors P ratio times EPS. Now let me explain a little bit here why it makes sense. We know that E/E, this is the P formula, times EPS or E, right? Now you can look carefully. This E cancel out. What left is P. Make sense? So that's why it makes sense. So the idea is you have to find out the EPS of the company, and then you have to multiply with the existing competitors or similar firms P ratio. That's it. Here is an example. Suppose a company had an earnings per share of 3. Industry P is 12. So 12 times 3, 36 should be per ratio. Now, there are so many different ways to do it. Some people say that use historical earnings. Some people say that use forecasted earnings. Doesn't matter, okay? Whatever you do, you have to mention, I use historical earnings, I use forecasted earnings. So a similar forms P times historical or forecasted earnings is gonna give you the price. So that's all for chapter 8. We actually covered this in the beginning of the class. Now let's go over a little bit about the homework 3, okay? So explain the features of common and preferred stock. Easy, right? Common stock have voting right, preferred stock do not have voting right, okay? Characteristics of dividend. So think of only common stock dividend, not preferred stock dividend. Characteristic of common dividend. It's not a liability. It has not tax deductibility, right? So think about this. Now, this problem, I think we did it today. Let's see. Voila, I think this one, yes. So here is the solution. So basically, this is dividend, this is growth rate, this is R over K slash. Now we also have to calculate B1, and then this is the price 0. So that's all. I think we finished chapter 8. We finished problems related to chapter 8. So that's all for the class. See you in the next class.